Thank you for having me here. So it's a very loaded question straight away, straight off the block. I think you use the word resilient. I think that is the key word if one has to describe the Indian economy in the last 11, 12 years. Because when the current government came into office in 2014, we should not forget that we started off with a huge, we were at the early stage of the deleveraging cycle, both in the corporate sector, and banks had to deal with the balance sheet issue. Fiscal deficit was high, and so was the current account deficit. So that was the inherited situation. So the rest of the decade went in repairing balance sheets and allowing corporates to repair, and government helping the public sector banking system also to repair its balance sheet, augment it. And in the process also the government undertook several structural reforms like GST, the Insolvency and Bankruptcy Code, and then the infra spending began in 1819. By the time that could be, the banking system and the corporate balance sheets got fixed, we had the housing finance and the non-banking finance problem in 1819 and 1920, before COVID, and then COVID. So if you look at it, then after that came COVID, the Ukraine-Russia war and the energy shock, supply chain disruptions in 2022, 23, and then 25 onwards has been tariff and then conflict. So you can imagine that every year or two there's been some major exogenous shock. But through all of this, the GDP growth rate, particularly post-COVID, there are very few countries that have maintained a sustained growth rate of 7+% in real terms post-COVID. And there are only 3 or 4 countries that have also seen their public debt ratio come down in this post-COVID period. The deficit also coming down from 9.2% to 4.4% as of last year. So basically the point is the supply side potential of the economy has been enhanced. That's a very big achievement. And the second factor, is most important factor that goes along with it, is resilience. And the third dimension is this growth pickup also has happened, or growth steadiness and growth at a high level has also happened along with the fact that the average inflation rate has come down. Between what used to be there in the first 6-7 decades is now lower, and we are converging with the developed world's average inflation rate of around 3 to 4% at some point. So I think the fact that you could sustain a high growth rate, improve the productive potential growth rate of the economy, and do it with inflation converging towards developed country average is an important achievement. So what could we have done more? I think given that the balance sheet problems were there throughout the bulk of the second decade, it's very difficult to say that we could have done more with capital formation. That would have been unrealistic, because that capital formation slowdown happened because of the first decade's excess capital formation in unproductive areas. The other dimension where we could do more, I would sort of saying what we could have done better, I would simply say what we should do in the next 20 years, we just got to get the demographic dividend right. Skilling and education, one part, everybody knows about it, talks about it. It's really the physical and the mental health dimensions of our demographic sweet spot, 15 to 29 years of population, that age gap, that age bracket. Their physical and mental health matter a lot for the next 20 years of growth. Those two aspects don't get much attention here. If you look at the National Family Health Survey number 6 that came out 2 months ago, and the fact that several states already have birth rates falling below the replacement rate, etc., the demographic dividend aspect is the one that needs a lot of attention. We can go on, there is plenty to talk about in terms of agriculture being the next important area where we need to work on distortions, etc. I would focus, and then the state capacity, the ability to make decisions faster. These are all the issues that one should think about in terms of what we need to do over the next 20 years.
So it's very refreshing to see an economist talk about mental health and physical health as the #1 priority. I think, thank you for sharing that. I'll take a slightly different turn, given that we have a large portion of the fintech community here, or the financial services community here today. If I look at, looking at some numbers in terms of gross value added, about a quarter of the contribution of India's gross value added comes from 3 sectors: real estate, financial services, and the services sector combined. And in which the financial services, of course, plays a big role. Now, in that, I was trying to find some numbers. how much of a role that the fintechs have played. And I was not able to sort of, do that without maybe getting into too much detail, so I skipped that. But what was evident for me is that in the last many years, in the last 10 years, at least in the last decade, there's a lot of investment that has gone in the fintech sector, both in terms of foreign investment, VC money, domestic and foreign, and of course a lot of subsidies that have come from the government of India also to support that sector now, right? Now, in your mind, as the economist here, do you think that the sector itself, I don't want to talk about what is the government going to do to give more capital infusion, because I think that's something that, everybody asks you. My question to you is slightly different. In terms of capital allocation that has happened by these companies, by the fintechs and the banks also, do you think they're allocating capital to the right sort of priorities for the nation? Payments has achieved scale and innovation, but have they really have impact on people's lives to the extent that the government have wanted? And where do you think they should be allocating more?
In fact, I just want to come back to the last point you made before you asked this question, that in a fintech conference, I spoke about the importance of physical and mental health as a priority, second, agriculture, and third, state capacity. And I was deliberate, not because I wanted to suggest that these are unimportant, but obviously, finance is an enabling sector. It is not the key. It is a sector that enables other sectors to unlock their potential. So it is an enabling sector. And when you ask whether the fintech sector has allocated capital, that is the call that the market has to make. Obviously, the allocation of capital to productive purposes depends also on the balance sheet size and the scale. And by and large, fintechs have more operated with a relatively limited capital size compared to a well-capitalized bank, and naturally, therefore, their ability to make a difference will be confined to relatively smaller capital needs sectors, which happens to be the SME sector or the self-employed and retail, personal finances, and so on. So in that sense, and that's not exactly trivial either, because that's what leads to auto loans, education loans, or for that matter, real estate loans, which in turn end up creating multiplier effects through these sectors. So I don't think a government economic advisor should sit in judgment over whether the sector has allocated capital in the most productive manner or not. That's exactly what the market system is supposed to resolve and figure out. And if it doesn't, from a risk-adjusted basis, if it doesn't turn out to be sustainable, or if it gets you into frequent cyclical capital misallocation problem, I think the market mechanism is robust enough to sort itself out. So I think I don't think the government should really be sitting in judgment as to what the fintech is doing, whether it is right or not. I think that should be left to the market participants themselves. Well, I have not been personally privy to that, and again, I'm a bit unsure if that kind of focus on making the turnover or the pace of activity in the fintech sector having to become a multiple of the GDP, whether a government of the day should be actively targeting that as a policy goal. I'm not entirely sure that's the right way to go, because that is a byproduct of economic activity itself. Because if you recall, I did say in response to your earlier question that the fintech sector or the financial sector itself, of which I was a part for 2 decades after my PhD. So I can say that it's being an enabling sector, it derives its strength and dynamism from the dynamism of the underlying economy. So the key is the economy growing well enough? And if the economy is growing well enough, then the financial sector will naturally be an important player or a peg to make that continue. If we end up targeting fintech activity, or in general financial sector activity itself, to become a certain multiple of the size of the economy, then I think we will end up killing the goose, which is the economy itself. And if you give the example of the United States and the UK as where the turnover, if I may say so, financial sector activity turnover is 4 to 5x of the real economy. That is also an example of 2 economies that I could say have over-financialized. And in the process, they have actually become more of, where the productive potential of the economy has been sort of given a secondary importance, where financial sector is the tail that ends up wagging the dog. So I don't think that ought to be a policy focus. We just have to make sure that the regulatory environment is predictable, stable, consistent, and doesn't stand in the way of legitimate economic activity and financial sector growth. But history and empirical evidence tells you, and BIS have been writing about it for a long time, etc. When we end up putting the cart before the horse, the finance cart before the real economy horse, then it doesn't serve either the real economy or the financial sector.